Is asset price inflation an accident or a systemic process creating ongoing pressures for long-term savers like yours? You are a long-term saver building wealth steadily, allocating to traditional assets, believing patience and diversification will compound returns. But what if asset price inflation contributes to mechanisms that erode real returns and favor early recipients? Today, we're analyzing asset price inflation, the macroeconomic mechanisms of money supply growth that influence long-term savers through distribution effects and purchasing power. The data reveals the truth unmistakably. S&P 500 up 500% since 2009, while CPI-adjusted wages grew under 20% with top 10% asset ownership at record levels. Stay with me to the end. This isn't isolated events. It's the clear analysis and path to financial independence that could help navigate these pressures. The explanation provided and experienced by long-term savers like you is that asset prices rise with economic growth, rewarding patient investment in productive companies. That inflation is moderate and contained, with returns outpacing costs over time. But look closer. Why do asset prices surge during money expansion, while wages lag, creating gap between owners and earners? Why do post-crisis periods show stocks and real estate leading gains? Why does buy and hold feel challenging when essentials rise faster? Insight 1. The system doesn't need hyperinflation to transfer wealth. It only needs asset prices to rise faster than wages for sustained periods. This isn't isolated events or unavoidable volatility. It's a systemic process rooted in money supply mechanisms that influence distribution through policy transmission. Asset price inflation isn't just market. It's the mechanism that affects saver outcomes. Post-2008 QE supported markets, 2020 measures repeated. The result: gains concentrate, real returns adjust. For long-term savers believing time in market, the reality is clear. The mechanisms have been in place, influencing outcomes over time. Intriguing? Yes, but who are the key players in this asset process? Who are the key players in this asset process? So you know you're not missing the bigger picture. It's not abstract market forces alone. It's central banks and connected financial institutions who shape outcomes through liquidity provision. Picture them as established participants in the financial system, accessing capital while you, building savings steadily, navigate the resulting pressures. The process works through transmission channels. Money creation flows to financial markets, inflating assets first. Long-term savers feel effects later: higher costs, wage pressures. A deep dive, post-2020. Trillions supported markets, S&P gains while essentials rose. Real-world impact. Savers adjust allocations, extend timelines, reduce spending while policy supports growth. It's continuing. Current signals balance sheet levels high, liquidity ongoing show process ongoing. Saifedean Ammous notes, money expansion favors asset owners. Lynn Alden notes, distribution effects widen gaps in expansionary periods. Insight 2. Gains aren't evenly shared, they concentrate where capital accesses liquidity first. History's pattern is clear: post-crisis liquidity affects distribution over time. These players shape outcomes as saver returns face sustained pressure. But understanding the process is the first step gaining clarity. Now explore the mechanisms at the core asset price inflation process, so you see exactly how it affects long-term savers building wealth. It starts with liquidity provision. Crises require expansion, money supply grows, rates low, cycle continues. Capital flows to markets, asset prices rise. Visibility activates. Essentials adjust later, real returns lag. Institutions get gains, compounding early. Savers pay with erosion, timing later. Everyday impact, portfolio nominal growth, but purchasing power challenges. History shows pattern: 2008 to 2021 bull market, 2020 to 2022 continuation. Current signals indicate continuation. Liquidity levels elevated, asset valuations high. Insight 3. The system doesn't require bubbles to erode savings. It only needs asset inflation to outpace wage growth consistently. Lynn Alden notes, money supply influences asset channels. Milton Friedman, inflation is taxation without legislation. Insight 4. Wealth compounds not from effort alone, but from positioning in assets that capture liquidity flows. The process isn't isolated, it's systemic, influencing saver opportunities over time. Think of it as capital flow, your steady saving navigating broader currents. But here's the pivotal shift: you don't have to remain affected by this asset price inflation process. Stop navigating as part of traditional current. Adopt the independent mindset. Understand the mechanisms, then position strategically. Conventional approach. Broad index exposure leaves you in the flow, your real returns influenced before fully realized. Redirect instead. Question every growth narrative. The clarity comes realizing gains concentrate from asset mechanisms, gain independence, auditing exposure to liquidity effects. Insight 5. Protection isn't chasing returns. It's allocating to assets outside expansionary channels. How much portfolio in inflation-sensitive holdings? Shift to independence. Preservation outside processes reach. History shows affected stay in current. Independent thrive, preserving value across cycles. Practical step. Minimize liquidity-dependent assets. Prioritize hard assets resisting dilution. Insight 6. True long-term advantage isn't market timing. It's owning scarcity in abundant systems. You're no longer in the flow. You're the one charting course in expanding waters. This isn't avoidance, it's pure clarity. You're positioned to turn mechanisms to advantage, emerging stronger from pressures. This is your initiation into true clarity. The deliberate path to financial independence from asset price inflation mechanisms affecting long-term savers. None of this is financial, investment, or trading advice. It's purely educational macroeconomic analysis for awareness. Always do your own research and form your own conclusions. Bitcoin is digital gold, limited to 21 million coins forever, halving every 4 years. No one can print more. Impossible to confiscate like 1933 gold. History has proven it outperforms every traditional asset class during fiat stress cycles, with multifold appreciation post-halving, such as over 10 times gains after the 2020 event amid unprecedented printing. The 2024 halving cut new supply issuance in half again, with 94% already mined, making it increasingly scarce over time, the only asset truly immune to inflation by design. In eras of asset inflation like today, this fixed supply property has positioned it as the ultimate tool for wealth protection, preserving value when everything else expands. Start your initiation. Read The Bitcoin Standard by Saifedean Ammous for the fiat parallels that will blow your mind, or The Sovereign Individual by James Dale Davidson, mapping the shift to individual sovereignty. Follow thinkers like Ben Cowan for cycle data, Lynn Alden for macro signals. Actionable: self-custody wallet, consistent dollar-cost averaging into Bitcoin as your scarcity anchor. This is the key to viewing money as your servant, not master. If this analysis has brought clarity, the drive to secure true independence, commit now to the next layer. Subscribe as your mark of joining this community of financial clarity seekers decoding the system together. The next insight is waiting.